Hi, I'm Vanessa from Premier Tax Solutions, and in this video I'm going to look at the 5 common mistakes that people make with tax returns. First mistake is people not declaring rental income. People think that you can get away without declaring rental income, but we know that HMRC are looking at the tenancy deposit scheme list, so you have been warned. Or because they pay out more in mortgage and repairs than they actually take in term of rental income. Just because you pay out more than you receive in rental income doesn't mean that you haven't got something to declare. Firstly, if it's a repayment mortgage, then you can only claim the interest element. Secondly, since the 6th of April 2020, you can only get basic rate income tax relief on any residential finance costs, so you can't claim the full amount of mortgage costs for tax relief anymore. You can only claim 20% of your mortgage payments. If you're a basic rate taxpayer, then since the changes it won't have any effect on you, but for those of you that are additional rate or higher rate, you're definitely going to be impacted. The second common mistake is not thinking that a tax return is needed. If you're a partner in a partnership or you're self-employed and you've got £1,000 or more of income, not looking at taking off any expenses, then you most likely need to do a tax return. You may also need to do a tax return if you receive other forms of income. This can be things like income from property, savings and dividends, or other untaxed income. If you receive child benefit and either yours or your partner's income is more than 50k, you may need to do a tax return too. Finally, if HMRC have sent you a notice to complete a tax return, then you need to do something about it. Please don't just ignore it. If it is that they are expecting a tax return and you don't file one, you could easily get over £1,000 worth of penalties. If you genuinely don't need to do a tax return but you've had a notice to complete, then you need to contact HMRC and ask them to cancel the requirement for a tax return. Common tax return mistake number 3 is incorrectly claiming expenses or totally missing them off. When you're self-employed, the things that you buy should be wholly and exclusively for business use. So if you've got a personal mobile, that isn't wholly and exclusively for business use and so shouldn't be claimed for. A lot of self-employed people only have one mobile and it will be used for business use, so you could claim for the actual use of it. So what you'd need to do is have proof of what a business calls and then you'd be able to claim for it. So the best way of doing this is getting your itemised bill and highlighting which are the actual business calls and then calculating it from that. Also, things like an Apple Watch. In HMRC's eyes, there'd be duality of purpose. Even if you're like me and you've bought one to be more productive at work. Clothing is another hot topic, so we have loads of people in the hair and beauty industry that try to put through things like black leggings. This isn't allowable because it's not branded workwear or protective clothing. A famous tax case based around a barrister stated that gowns and wigs would be an allowable expense, but items such as suits and blouses wouldn't be, even though it was required as part of the Bar Council. Don't forget to check your personal bank account for things that you may have paid for personally, such as professional subscriptions. Common mistake number 4 is going over the VAT threshold but not registering for VAT. The threshold for registering for VAT is 85k turnover, so if you've gone over that in a 12-month rolling period, then unless you're exempt for some reason, then it's most likely you need to be registered. You have to register within 30 days of the end of the month where you went over the VAT registration threshold. The effective date of registration is the first day of the second month following you going over the VAT threshold. If you don't do your tax return till the January, for example, and you went over the VAT threshold in March, then there's a lot of time that's lapsed and a lot of VAT that may need to be caught up on. If you're late registering for VAT, then you should pay VAT on any sales that you've made since the date that you should have been registered. As you can imagine, this could leave you massively out of pocket. You may also get a penalty depending on how late your VAT registration is and how much you owe. The 5th common tax return mistake centres around capital allowances, so either not claiming them or using incorrect pools. Capital allowances are a way of obtaining tax relief on certain kinds of capital expenditure. The most common assets that you might purchase that would qualify for capital allowances are things such as vans, cars, tools, specialist plant and machinery. And there are different kinds of allowances available. For example, annual investment allowance, which gives 100% tax relief on assets qualifying as plant and machinery. It's not available on cars and other assets that you may have owned before, so something like personal use. Cars will either get 100% first year allowance if they're zero emission cars and are new and unused. Otherwise they'll fall into a pool with either 18% or 6% writing down allowance, which is dependent on the emissions of the vehicle. Private use adjustments are also required for these assets. So, as you can see, the rules on capital allowances are actually quite complex. So these are the 5 common mistakes that we see on self-assessment tax returns. The deadline's the 31st of January, and if you need any help, then get in touch. Thanks for watching.